Hello everyone, welcome back to another video. In today's video, we are going to look at intercompany journal entries. I'm going to discuss with you various intercompany transactions and how to record them. So make sure you watch this video till the very end. So without any further ado, let's get started. So the first case which we are going to look at is sale of inventory between intercompanies. So our first transaction is corporate wala Delhi company sells inventory to corporate wala Mumbai for $45,000. So let's talk about what will be our journal entry in the books of corporate wala Delhi, which is our selling intercompany. But before we pass on this journal entry, for next couple of minutes, I want you to imagine that we are not passing any intercompany journal entry. Instead, you need to pass a journal entry for credit sale. So what will be your journal entry? You will debit the receivables and you will credit the sales. So this is the entry which you will be passing if you are making any credit sales. But this is credit sales but to a intercompany. So instead of writing receivable account, what we can do here is we can write it as intercompany receivable account. So our final entry would be in this case intercompany receivable account debit with 45,000 to sales account. I hope the logic is clear to you. We have done nothing but included intercompany word because the transaction is related to a intercompany sales. Okay, but this is not it. We have to pass the journal entry in the books of Mumbai as well. So in that case, what will be our journal entry? We will debit the inventory account because they have received the 45,000 inventory, and we will credit the intercompany payable account because as you can see corporate wala Delhi company sold 45,000 inventory to corporate wala Mumbai. So if in Delhi books they have a receivable of 45,000, in Mumbai books they need to create a payable of 45,000 as well because they are getting goods from Delhi intercompany. So our receivable is always be equal to payable account. Okay, moving ahead, let's talk about our second example, which is going to be transfer of equipment from parent company to subsidiary company. So now let's look at the transaction which has taken place. Parent company transfer equipment with original cost $15,000 and accumulated depreciation $5,000 to subsidiary A. So in that case, in parent company, what will be our journal entry? We are transferring our equipment to subsidiary A. But again, for a moment, let's forget that you are passing any intercompany journal entry. Instead, let's imagine if you're selling your equipment on credit to a company, what will be your journal entry? You will create a receivable and your equipment will be gone, but so is your accumulated depreciation. So your entry would be receivable account debit, accumulated depreciation account debit to equipment account. But it is an intercompany transaction. So instead of just writing receivable account, what we can do here is we can write intercompany receivable account. So our entry would be intercompany receivable account debit, accumulated depreciation account debit to equipment account with 15,000 rupees. Now, again, if you want to pass entries in subsidiary A books, what will be your journal entries? So again, as I mentioned in previous question, like receivable, you have to create a payable as well. So you have created 10,000 payable amount. Again, you are getting equipment here. So you will debit the equipment and you are also getting the accumulated depreciation. So you will credit the accumulated depreciation. So your final entry would be equipment account debit to accumulated depreciation to IC payable. So I hope both the entries are clear to you. Now moving ahead, now let's talk about our third entry, which is going to be loan from parent company to subsidiary company, which you can also call as intercompany loan. So our transaction is parent company provides a $50,000 loan to subsidiary B at an interest rate of 5%. So in the books of parent company, what will be our journal entry here? So for parent company, they are giving a loan, so their cash will be reduced and they will create an asset of intercompany loan. So what will be our entry here is intercompany loan receivable account debit to cash or bank account with 50,000. Again, you need to pass the journal entry in the subsidiary books as well. So in subsidiary books, what will be your journal entry? Because they are getting loan, so they will create a loan liability, and because they are getting cash against that loan, so their cash or bank balance will increase. So our final entry would be cash or bank account debit to intercompany loan payable account. Okay. Again, you can see receivable is always equal to payable because from one hand they are giving and one hand they are taking, so both of them would be equal in any case. Now so many of you would be thinking, don't we need to pass the interest entry here? So answer would be no, because right now we have just given the loan. We need to pass the interest entry only once the interest is due. So the interest on loan entry will look in the next example. Okay, great. So moving ahead, now let's talk about our final example, which is interest on intercompany loan. So taking the same example again, if we need to pass the interest on this loan, what will be our journal entry in the parent company? So they will debit the intercompany receivable again with 2500, and they need to also record the interest on loan income. So the final entry would be intercompany receivable debit to interest on loan account. Now, so many of you would be thinking, don't we need to debit the cash here? So no, we are not debiting the cash because currently we are just booking the accrual entry. We are assuming that we have not received the cash yet. Now moving ahead, what will be our entry in subsidiary company? So like parent company has created a receivable and income, subsidiary company need to book a expense and payable. So what will be our entry? Interest on loan account debit, which is our expense, to intercompany payable account, which is our current liability. And again, this is the accrual entry because we are assuming that the payment has not been yet made. So let's take a quick recap. We have covered sale of inventory journal entries, transfer of equipment journal entries, intercompany loan journal entry, and interest on intercompany loan journal entry. So these are the 4 journal entries which we have covered. If you have any doubt or questions, feel free to ask me in the comments. If you got any value from this video, make sure to hit like and subscribe to my channel. It will motivate me to make more such video for you in future as well. If you want to download this PDF, you can get it from my Telegram channel. I'll give the link in the description of this video. Thank you so much for watching. I'll see you soon in next video.